The dollar is in jeopardy. What are you talking about? How could it be? It's the reserve currency. It has the monopoly, the petrodollar. All of that is being challenged today. I'm going to bring you this information you need to know, so let's begin. My name is David Quintieri and I am the Money GPS. I've been doing this for well over a decade, knee deep in the trenches, digging up the information that the other guys won't. I bring it to you fast, I bring it to you first. What I'm going to show you today is all around the US dollar and, of course, the emerging difficulties that are being experienced on Main Street. I'm going to show you what you need to know, beginning with this right here. You're seeing the US president saying that higher interest rates for credit cards, car loans, and mortgages, payments for security, Medicare, our troops, veterans could all be delayed. Our economy would fall into recession and our international reputation would be damaged in the extreme. We shouldn't even be talking about this situation. What is that situation? Not raising the debt ceiling. We are still discussing this, and of course, until the day that they decide to pass it, it will all be there. And that is all true, all of these things. Like if they don't actually pass the debt ceiling, they don't raise it, they don't pay the bills, they don't pay off their creditors, yes, it's going to be a problem. But let's be honest, they will. Okay, and so they'll squabble back and forth and they'll continue to do this. It's all about appearances. That's where we're at, okay? So you could look at it and you can get sucked into the politics. I don't do that. I really don't. And you could do that if you'd like, but I mean, it's all here. It's really all there for us. Treasury debt advisors warn of seismic impact from US debt payment delays. And so this information does highlight the truth. And that is, if the United States, the biggest economy in the world, the one that owes the most debt to anybody, the one with the biggest military, the one with like number one in so many different stats, if they didn't pay their bills, it would be the number one biggest problem in so many different ways. Wall Street executives who have advised the US Treasury's debt operations for the past 25 years are deeply concerned about the debt limit impasse that has markets worried about US default on payment obligations. The markets aren't actually worried. Investors might say a few things, but let's be honest, they're not. You could see that the jitters are not there. The volatility that's supposed to be in the market, that's not there either. I think it is very clear that the expectation is that they are going to do something at some point. Now, if they didn't, then we have a problem. Up until then, let's be honest, okay? There will be a direct impact on any issuer whose credit relies on the backing from the US government, such as mortgage entities like Fannie Mae and Freddie Mac. You know and love those institutions, don't you? They were put onto the backs of the taxpayers after the housing crisis, and nothing was ever really done about that, but here we go. Repeat bankruptcies are piling up at the fastest rate since 2009. Billions in debt is restructured again, proving first failed. U.S. courts saw at least 11 so-called Chapter 22s through April. You could see the trend right here. Repeat bankruptcies, highest or the fastest pace since 2009. Quite significant when you see this and understand what's happening here. Yes, there's companies like David's Bridal that were coming up during that time frame, and now again, it just shows us that you absolutely cannot recover if you never really fix your problems. And that's kind of the issue when we look at it on the national level as well, as we'll talk about with Argentina in just a second. At the end of this video, I'm going to also be highlighting an important video that gets into this in more depth, so you want to stay tuned. Okay, so the problems that we have back in 2008, financial crisis timeframe, they were not fixed, they were not resolved at all. What they did was they took from the private hands and they put that onto the public hands. What am I talking about that? Companies, they started failing, they started doing poorly, so the government stepped in and said, we're going to bail these out. And they took all that and they essentially said, we are going to nationalize this problem. And that's exactly what they did. And so the next time around, the next crisis, which basically we are in right now, is no longer a crisis of corporations, though the corporates can have problems. It's now a problem with the governments. Sovereign debt defaults, as early as 2011 and 12 in Europe, started to pop up and become apparent. You could look at the same situation with Argentina today as just one example. But if we take a step back, zoom out 30,000 feet, and we look down at what is happening in the US, it is problematic to say the least. They really can't pay their bills. And if we factor in the de-dollarization that is happening, then who's going to buy the US debt? Who's going to buy it if China is making all these deals with the BRICS nations who are growing massively? Stay tuned for that, because I'm going to show you in June the big steps that are happening. Hit that subscribe button, okay? And you're going to get the notification on that one. What we're seeing here is a big trend, a big shift that puts the United States into the corner. And what does an animal do when it's backed into a corner? That's right, it fights. And that's not a good sign for the whole world. Argentina is going broke to stall a full-on currency crisis. Central bank has more liabilities than assets on its balance sheet. Gross reserves have slumped to 34 billion. That's a 7-year low. This is yet another country that will, or I should say another time that they are going to go bankrupt. They are going to default on their debt. It wasn't long ago. I'm going to tell you a little story for those who aren't familiar with this channel for a long time. A little while ago, Argentina had century bonds. And what am I saying here? What's a century bond? A bond that matures in 100 years. Would you trust would you trust Argentina with a 100-year bond? That means you're going to give them money for 100 years. Hopefully you survive that long. I hope you do. And then at the end of that, they're going to give you a return back. That's kind of what I'm suggesting. What about another country? What about some European country? Would you trust that for Greece, for Germany, for France, for the UK maybe? What about the United States? Would you trust it for 100 years? And if so, what kind of return would you be looking for? Well, in the case of Argentina, they gave a decent return, and they don't, obviously investors don't hold to maturity, but that's the idea here. Not only did they sell out, they were actually oversubscribed. So more money wanted to buy these things than was even available, than was issued. Like, that's the crazy thought of all of this. Argentina is going to go bankrupt again, and here they are, billions and billions were being poured in. AI will create a serious number of losers in the job market. That's according to none other than DeepMind. That's Google-owned AI lab, okay? Of course, what's happening here? As they say, unquestionably, many of the tasks in white-collar land will look very different in the next 5 to 10 years. If you truly do expect your job, not you specifically, but like the general public's jobs, to be there as they are today, you are completely being misled. There are going to be a serious number of losers, and they will be very unhappy, very agitated. You know how many jobs, back office jobs, are already being replaced? I used to see so many jobs that were people, they would get in the financial world, they would get a check. They would take that check and somebody would type in the details of that check into that system. It would move through that system, and then there was some level of automations that would go through it. Statements would kind of roughly be, processed automatically, and then it would get printed and it would get mailed out to people and so on. But you got to think about this for a second here. Now, that system is done entirely by the machines. The only thing is a human verifies that the computer did it accurately. So the job is completely changed in a very, a few year span. So imagine the next step. No longer do you need a human to do it. All they do is when there's a problem, then a human could come in and resolve that. That's coming right now. And that is like in any financial organization, a lot of that back office employs maybe not high paying people, but a large bulk of them. So think about how many financial companies, you go downtown, you see the big towers. A lot of those positions these companies are spending millions and billions of dollars in order to replace the bulk of those employees. What happens when the bulk of those employees lose their jobs? They can't all be OnlyFans, creators or whatever they call, okay? I don't know what the world has in store for this, but it's not good. And if you're not taking advantage of this system right now as it is, you are losing out. Okay, big time. Now, Warren Buffett, Mr. Buff, he did something. And I wanted to show it to you because it links in with all of this. Check it out. Warren Buffett dumps billions of dollars of US stocks, indicating that he correctly anticipates that a US recession will make landfall in the near future. In the past year, the US money supply, measured by the M2, has contracted by 4.1%. This flip from expansion to contraction is the steepest adjustment in money supply growth in post-war US history. I covered this a while back. I noticed some people doing videos after that, like well after that. I had brought it up before, but not many people watch that. But anyway, with the usual lag of 6 to 18 months, economic activity will take a turn for the worse. When a recession is right around the corner, Buffett knows that cash is king, particularly when he can earn a decent rate of interest on it. And that's exactly what's happening here. He's happy to make a few percent interest, hold it in cash, $130 billion of cash that is, and simply wait for a better buying opportunity. He's good. He's good just waiting it out. Why? Rule number 1, don't lose your money. And yet people just make that mistake. Why? Fear of missing out. Oh, I need to get in. I need to buy. No, you don't always need to buy. Okay? And if you're going to buy, it's better to buy something when you know there's a risk on mentality. This is not 2017. 2017, there were no risks, supposedly. No risks. That was Goldilocks each and every month. Then you could add to positions. When there's big concerns, step back. If you want to add to positions, make it a defensive one. World Bank chief calls for urgency on poor nations' debt at the G7. This is just highlighting the fact that what we can see here is not just the United States and the de-dollarization, but a lot of countries are dealing with the same problem, all because of what? Increasing interest rates, tightening financial conditions globally. Global slowdown. At the same time, part of that was 2020 related, lockdown the whole world. You see what happens. Ohio food banks report surge in demand amid recession fears. It scares me to death. An Ohio food bank administrator told ABC. Think about this. Of course, this is going on everywhere. Toronto food bank surging. Look at what's going on in San Francisco. Look at New York. Look at these cities, big cities with millions of people, and yet they're unable to pay their bills in many cases. But are they doing anything? Are they saying anything? Is this all going to be handled? Of course not. It's not going to be handled. As they say right here, U.S. prices rose in April, showing inflation pressures persist. I see comments from you each and every day from all around the world telling me services and products continue to go up. They're not going up whatever they say here. It's 4%, it's 0.2%. They're not doing that. They're going up much faster. They're going up much higher. And as I'll say all the time, they're not going to go down. Sure, if there's a massive deflation, if there's a wave, if there's a depression, difference, okay? But the likelihood here is that we enter a crisis and they just print a hell of a lot of money and destroy the value of your currency, and prices go up. Wages don't keep up, although they can elevate. They can't go up at the same rate that everything else does. Price pressures will crush people, absolutely crush people. Sri Lanka struggles to recover a year after economic and political collapse. This is just one nation getting involved with the IMF. You can never resolve your problems once you get in bed with the IMF, but my goodness, that's a whole different story. I'm just showing you it's global, okay? Global problems that are happening right now. You've got to understand this, okay? The bank crisis plus the debt crisis that's happening right now is worse than in 2008. I'm telling you, this is actually worse in one statistic that I discovered right here in this video. You've definitely got to check it out. I'll put it up on the screen. Check this video out. I'll see you there.